Hi, everyone. This is Jason Bierko of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. Him and his firm have been managing money for over a decade. He is a chartered financial analyst. He also advises a lot of different business owners and professionals, and his interviews have been on USA Watchdog, Gold Money, Zero Hedge, Casey Research, Mises Institute. Christopher Casey, thank you for joining me again.
Thanks for having me, Jason.
So, Christopher, we're recording this interview on Tuesday, January 23rd, 2024. The dollar index is at 103.55. I want to get your thoughts, though, on kind of the Austrian theory of the business cycle. It seems like it's playing out over the last 3 to 5 years with the artificial boom, with the currency and credit creation that the Federal Reserve Bank and the other central banks have flooded the global economy with in 2020 and 2021. It really seems like the currency and credit increased even more. Do you think we're going to see a bust in the near future with the Fed rate hikes?
I think it's certainly possible, and I think it's quite likely, actually. I mean, and not only a bust and a recession, but potentially a very devastating one. And just to kind of recap why that is, first of all, it is critically important that you have a theory, an economic theory as to what causes recessions. And shockingly, most people don't. Most wealth managers do not. They say they're agnostic as to theories and to where the economy is going, which is just silly, right? And if you don't have a theory, then you're basically just trying to read tea leaves as to what's going to come down the pike in the economy. And so just to kind of recap quickly what the basic concept of the Austrian theory of the business cycle is and how it kind of comports with today's environment. Essentially, any theory has to explain certain phenomena that happens, right? There's that you see in every single cycle, every single recession, and the boom preceding it. So you have to explain why there's a cluster of error. Why are business people making all these, in retrospect, horrible decisions about investments, and all of a sudden have to liquidate things? So number one, they have to explain that. You have to explain why any recession tends to be, or always is, preceded by an expansion of the money supply. You have to explain why the capital goods industries tend to fluctuate far more wildly than consumer goods industries. And I think finally you have to explain, why is it recurring, right? Why is it happen time and time again like clockwork, as opposed to just a one-off event that you can point to some kind of exogenous situation occurring? And so the theory is that essentially interest rates are a key price. They're a price that permeates the entire economy. It's based on time preferences. It helps structure the division between capital goods and consumer goods. And it's what we all base many economic decisions on. Every economic actor looks at interest rates in making any type of decision, essentially. And when you increase the money supply, in part or largely because you're buying bonds, you're artificially decreasing interest rates temporarily. It's an artificial false signal to the economy, which then everyone starts acting on. And ultimately, you can only increase the money supply so long, or you're going to cause runaway inflation. And so at some point, you have to cut back on that. And when you do, that's when the malinvestment that's been caused by the reduction in interest rates is exposed. And that's the recession, which is actually a good thing because it's liquidating unproductive assets and restoring them to more productive hands. And so if you look at that if you look at that theory, how it relates to today, we saw the buildup, right, since post-lockdown or during the lockdowns. We saw the reduction in the money supply over the last, 14, 15 months now. We're at unprecedented year-over-year monetary growth, negative monetary growth signals that has occurred. And the last time we saw something like this significant, was literally the Great Depression, right? So we see the cutback. We saw the rise in interest rates. They're not as manipulated as they were before. So they rose on the short-term rate. And this is all kind of a hallmark as to what you would see preceding a recession. And the thing that really kind of caps it off is then, of course, when you start looking at other signals, such as the inverted yield curve, you look at the leading economic index or the purchasing managers indices. You look at all these different indices, and they're all flashing red. If Chairman Powell was a pilot on an airplane, the entire dashboard would be red, the co-pilot would be MIA. He would look over his shoulder and see an engine literally on fire. And Chairman Powell is no, Sully Sullenberger. So things things could very well not end well, and they may not get the soft landing they're looking for.
Well, I think the Fed is built to kind of, well, in theory, the Fed's supposed to be what the counter-cyclical or antithesis of the free market, because I would argue the free market wants deflation, the free market wants bankruptcy, it wants to purge the malinvestment, like you said, the bad capital allocation. I think that governments and central banks do not want deflation and bankruptcies because of what the debt-based fiat currency system we have, fractional reserve banking. That would potentially lead to 2008 with all the leverage in the system, all the credit, and then the derivatives market.
Well, you're right. And I mean, even the name Chairman Powell, it harkens back to, kind of Politburo type style, which is basically what the Fed is, right? It's a cartel of leading banks and government appointees. But you're right. I think it was Doug Casey said years ago, and I love this quote, something to the effect of, the Fed, if you put the Fed in charge of the number of bananas in the U.S., you get disastrous results. So why would you not get the same when you put them in charge of money, right? It's an impossible thing to dictate apart from the free market. I lost my train of thought there, but you were commenting on how we relate to the previous '08 downturn. And the biggest difference is that things are worse, right? You look at debt levels, things are a lot worse across the board, whether it's national or otherwise debt. So things, even though they rhyme, obviously history rhymes, things could be worse than they were back then.
Well, also, I think in a debt-based fiat currency system, fractional reserve banking, and how much total global debt has increased from 2008 to today, another $100 trillion in total global debt was added. I mean, if that debt starts to default, it's a vicious cycle then where government tax receipts collapse, the private sector, people lose jobs, recession, tax receipts, and then the Fed basically has to step in and start to fund government then.
Yeah, what's even worse? You don't have to have defaults. All you have to have are maturities. So, for instance, just put some numbers to it. The Treasury Department has to issue an immense amount of debt, not just to finance government expenditures, but also to refinance the debt they already have, right? So there's rollovers that occur. And because the Fed has traditionally done a lot of short-term debt, they missed an opportunity 4 or 5 years ago. They could have had, it's never happened before in the US, but they could have had literally a 50 or 100-year bond they could have issued at some ridiculously low rate. They didn't do that. So right now, we're in a situation where there's going to be an immense amount of Treasury issuance this year, something like $9 trillion, right? We're talking almost, a third of the national debt right now, 34 trillion. So it's a big number. Add to that any kind of deficit we're going to have. Last year we had a deficit of 1.7 trillion. Who knows what it could be this year? It could be far worse, especially if there's a recession and tax receipts go down. All of a sudden, you're looking at a really big number to issue. And when you do that, there's a couple of things that happen. One is that you're going to increase rates because the Treasury has to compete with other bond issuers, right? So they have to offer a fairly high rate to attract that capital. But on top of that, when you roll over that short-term debt, you're rolling it over at much, much higher rates. So a couple of years ago, let's say early 2022, the average interest rate was something like 1.5% for U.S. government that they were paying. At the end of last year, it rose up to over doubled. It was like 3.1. Well, now if you just take another increase, take a third of that and roll it over at 5%, now you're over 4%, right? And if you're paying 4% on 34 trillion, you're talking about an interest payment. No, it's over 1.2 trillion. I'm sorry. That's over. That's I'd say about $500 billion more than the Defense Department spends. So you're just at a massive amount of, let's say, 1.3, 1.2, 1.3 trillion you're paying in interest. It's just a huge line item now in the budget. And of course, like you're saying, now it's a circular issue because now they have to issue even more debt. The Federal Reserve has to step in even more to make up for that. And it's just a vicious cycle.
Or they try to raise taxes on the private sector or consumers, and then that hurts the economy even more. That hurts people's standard of living. Business owners decide, hey, if the taxes are this high, I'm not going to make investments into my business. I'm going to sell my business. I may stop doing business. I mean, that the raising taxes also creates different economic signals too.
Oh, and yes, and it also depends what they raise, right? That distorts a whole bunch of different preferences and demand curves. Like, so for instance, I think it's the economist Bob Murphy, he used to always say, well, people generally agree that so-called sin taxes affect your behavior, right? If you tax alcohol and cigarettes, it decreases demand for those goods. Well, what do they think income taxes do? And if they keep increasing it, it does have an effect on economic actors, right? It affects people. Maybe they'll still go out and work just as hard, but now they're looking for more tax shelters, what have you, and it's an unproductive use of resources. Um, Maybe they're playing games with how they're paid, whether it's timing or otherwise. And so it's a horrible burden on society that's far greater than just the actual dollar amounts you're talking about.
So I want to get specifically into how our banking system works with like Silicon Valley Bank and some of the other regional banks that have had problems. So all that currency that was created here in the United States, and there was trillions created outside the United States, but I think there was around 6 trillion here in the United States created from 2020 to 2022 alone. So there was a lot of currency debasement prior to that, but just in that short amount of time, 2 years, there was an insane increase, I think 40%, give or take, on one of the smaller versions, what, M1 or M2 of the money supply. So when the banks start to get those deposits, they're not going to hold the cash, right? So they're going to there's going to be a lot of misallocated capital there, right? The banks are either going to buy treasuries, which have losses now, or they're going to start to give out loans at lower interest rates. And then the Fed's going to raise rates. So the banking system now is paying the price for the Fed doing that action, right? Of flooding the economy with artificially cheap currency and credit when they lowered interest rates, right?
You're right, and I wouldn't be surprised if we have another banking crisis or issues down the road this year. Of course, you mentioned Silicon Valley Bank and these other ones, and you're spot on. They get the money and they have to do something with it, right? It's not cash, and so a lot of them obviously bought long-term treasury bonds. Interest rates rose, the value of those decreased dramatically, and they were bailed out last year by the Fed and Treasury. And so, by basically lending those assets to the Fed and then getting their cost basis instead of the fair market value. So they were able to get funds, liquidity, and artificial values, right? That didn't comport with reality. And I'm actually surprised they're not doing a similar program right now um, with the real estate loans that are in the banks, especially for these regional banks, because that's obviously the next shoe to drop. So I wouldn't be surprised if we see a program like that and come into play in the near future. And I think we already see it too. The Fed's signaling things like that. Like for instance, over the last month or so, can't remember the Fed member, but they're trying to take away the stigma of borrowing from the discount window. So whenever a bank, has to go to the Fed for money, that obviously should be interpreted as a red flag, right? There's a potential issue there. But they're trying to destigmatize that by having all the banks do that and taking liquidity from them. So it's effectively adding a cloak of opaqueness to the industry, whereas before it was a little bit more transparent because I think they're scared.
Did you read John Allison's book from BB&T? He was talking about basically he was forced to, during 2008 financial crisis, BB&T Bank, and John Allison's a libertarian, Austrian School of Economics. He was one of the only banking CEOs that's Austrian School libertarian. And he was talking about how like government regulators basically, I think during 2008, threatened to put him in prison if he didn't borrow from the Fed from all the emergency liquidity programs. Their rationale was if all the banks borrow, then the short sellers can't figure out which banks are in trouble.
Yeah, I think they're taking that playbook, they're dusting that playbook off and going to do it again. And it was even worse than that because, as I recall from that crisis, they made everyone take the money, and then they would criticize them for how they used it. So, for instance, and I'm not going to mention particular banks, but I know some banks that went out and maybe they'd sponsor an event or what have you, and then they would be eviscerated by government officials in the media for doing that with their so-called government money. How can you do that with taxpayer money? Well, you made us take it, and we're just trying to spend it in the best way we can.
Yeah, I mean, Allison said he didn't want the money, but he said he was literally threatened with fines and prison time if he didn't.
Does not surprise me.
Well, it sounds like out of one of your favorite and my favorite books, Atlas Shrugged, Ayn Rand. It sounds like the business owners, basically the government saying like a bunch of Wesley Mouches saying you have to do this, you have to do that, or we're going to put you in a cage.
Yeah, I think I'm just waiting for hopefully my memory is correct here for Directive 10829 or whatever it was to come down the pike.
So you mentioned that credit is contracting. I mean, like it seems like the Fed's just playing a shell game here because yeah, maybe the banks aren't loaning into the private sector economy as much, so that's a credit. Like the banks don't want to give small business loans as much high interest consumer debt because they're already soaked with loan losses and stuff on auto loans, consumer debt, credit cards, other stuff. But like on the other hand, these shadow liquidity programs, and you mentioned one is the BTFP. It just seems like the Fed is creating the narrative is, oh, there's deflation, oh, credit's contracting, but the shadow liquidity programs are offsetting all this stuff. I mean, the banks still can go to BTFP, which is over $100 billion. They can borrow from FHLB. I'm sure there's other shadow, I think reverse repo they can draw from. There's other, or repo, there's other markets that they can draw liquidity or shadow liquidity from too. So I think the net effect, I don't think there's really liquidity being taken out of the system yet. Look at the stock market.
Well, I think the Fed, they're scared, right? So they're always going to say one thing and do another, but it's even worse where they'll say two things, right? So, for instance, they're constantly trying to jawbone the markets and talk them up by promising or at least hinting at rate decreases, and then they'll trot out after however the market goes up and they interpret that as a great sign. Then they'll trot out some other Fed member who gives a speech, at some event where he'll downplay it. So they're constantly sending mixed messages. I mean, Greenspan was famous for sending no messages, right? He just wanted people to be confused. But I think here they're trying to have their cake and eat it too, where they want to look like they're in control. They want to look like things are going to be fine, and they're just praying that we get past, or at least get past their own terms, without having a recession. And it's really, people talk about how it's a dual mandate at the Federal Reserve, which, by the way, I think is just factually incorrect. It's actually a triple mandate because it's reasonable rates, it's unemployment, keeping that at a reasonable level, and it's also price stability, right? So there's actually three components. But on top of that, the fourth most important unspoken mandate is to keep the stock market propped up, which is what they're constantly trying to do by speaking to the market and investors.
This sounds like the Cantillon effect here. So you mentioned distortions because the private sector and the banks themselves to like the consumers or small businesses, they're not getting credit if people can borrow. I mean, the terms are bad, but a lot of people aren't borrowing. But meanwhile, if you're like a hedge fund manager or a bank, or you're I guess a family office or an institutional investor, you can still, or even a government, you can even borrow relatively cheaply. So it seems to creating even more distortions. Do you think that this is like a perfect example of the Cantillon effect?
Yes, and just so everyone understands that it's named after a French economist who noted that the investor or the actors, the economic actors who get the money first, are able to use it before prices go up, and they basically have been their wealth has increased relative to the others in society, right? So that's the concept, and yeah, that's always true. I'd say with any kind of monetary expansion that's always in place, it always impacts Wall Street versus Main Street, right? It always favors Wall Street over Main Street. It always helps the big banks. It helps New York, the big money. That's always the case.
And Washington, D.C. metro area, which now has 5 out of the 10 highest average median family income counties in the entire United States.
Yeah, well, it's a lot of lobbyists making a lot of money too.
Government employees, too. I mean, there's a lot of government employees who are making over $100,000 a year and they can't get fired for felonies.
Yeah, and they'll keep making that probably after they retire too.
Janet Yellen, I think, has her and her husband combined, I think they have half a dozen pensions.
It's not bad.
It's a good racket. Yeah, it's a good racket. But the Federal Reserve Bank, they had so the Cantillon effect. I want to continue this. So starting in the Alan Greenspan Fed, they were overtly promoting this wealth effect. I mean, that's the Cantillon effect, right? They were trying to juice the stock market so people felt richer and they would go out and spend more into the economy. So that was intentional asset price inflation, and that's the Cantillon effect, wouldn't you say?
Yeah, I haven't thought about that in a while. I actually wrote an article called "The Wealth Defect" a number of years ago. But you're absolutely right. The theory being is everyone at least feels richer and goes out and spending. So it's based on a couple of fallacies, right? And one of the main ones is that consumer spending drives the economy, which is not true. And it's a classic Keynesian concept. Instead of saving, which is really what's helping drive the economy. So you're absolutely right. It's another, Fed believes in a lot of fallacies out there, unfortunately, and that's one of the main ones.
Yep, I 100% agree. So they've been intentionally with the wealth effect, aka the Cantillon effect, which it really is, intentionally juicing home prices and intentionally juicing the stock market. And then when people have a higher home prices and their home prices have been going up for decades, or they can refinance at lower interest rates and get a cheaper mortgage, and the stock market's going up. I mean, the Dow, what the S&P 500 just hit an all-time high, and look at the global economy. I would argue a lot of the global economy is already in a recession.
Well, I think, yeah, including U.S. Obviously, I think there are a lot of data points that way. But you're kind of about people feeling richer. Well, you are going to feel richer when your house value goes up. But if you can't sell it and you can't finance it, you can't get a mortgage on it at a reasonable rate. Even their own theory, although it's, I believe, faulty, falls on its face right there.
So I want to transition now to commercial real estate. I think you said that that's probably going to be one of the biggest problems in the next couple of years. We've just been getting warnings over the last couple of weeks from the CEO of Bank of America. He's warning about the lag effects of the rate hikes. He said none of the problems or damage is priced in yet, really, in his opinion. Bank of America has written off a lot of losses on treasuries, at least on paper. But I think the newest warning that has me the most worried, the CEO of Cantor Fitzgerald Bank, which is an investment bank that issues like research and does a bunch of investment bank stuff. They're a little bit smaller, I think, than like Morgan Stanley and Goldman Sachs. He just said that there could be $1 trillion of commercial real estate losses in just the next 2 years. He thinks things are that bad. So do you think that this is probably the next biggest crisis for the Fed and the government?
I do, and you don't need it to be that bad to be a crisis, right? If you could easily get to 100 million, I'm sorry, 100 billion in losses, which would be devastating to the banking industry, uh, just by reducing that loan portfolio by say 10% or so. It doesn't take a lot because banks are inherently, just based on the nature of fractional reserve banking, forget all the regulations and capital requirements they have. They're inherently unstable based on their lending practice, based on fractional reserve banking, right? They're lending out stuff that they don't actually own. And so it doesn't take a lot to stress it. And if you have any significant decrease here in the values of the portfolio as it relates to commercial loans, you're going to see some real stress out there. And it could be a lot worse. It could be a lot worse than what we saw last year with the treasury bond issue causing problem with banks. And the ultimate repercussions of this is a little bit scarier because I think what you're going to see is through the bailouts and through these forced mergers that they'll do, right? So it's mainly the small banks that have this exposure. They got to be swallowed up by, J.P. Morgan or what have you. And when you do that, all you're doing is consolidating the banking industry and making it worse and making it more of a cartel and making it more easier to control, which is, of course, I think ultimately what they want.
I think, yeah, the government prefers too big to fail. Then it's easier to implement in the future what central bank digital currencies, cashless society, more taxes, maybe a centralized database there. So all people's economic transactions, they can't transact in cash, maybe outside the banking system. I think that's kind of the goal. But you brought up an important point here about fractional reserve banking. It says in your bio here that Murray Rothbard is one of your favorite authors. I mean, I've read his books on the Great Depression, on the Wildcat era, which was fractional reserve banking prior to what the great financial crisis, the panic of 1907, and the Federal Reserve Bank being implemented. So I think the average person out there doesn't understand the banking system. Fractional reserve banking is way more dangerous than DC and the Federal Reserve Bank would have us admit, right?
Absolutely. And it's much harder to understand. In fact, if you talk to a banker, let's go say a guy who's a commercial loan officer, they don't even know that. They don't even know what they're doing. Like they literally have never thought about it. So Rothbard has a number of books on this, which are all great. Everything from the Great Depression to I think his thesis was the 1819 panic to things like what has government done to our money. But all those kind of things really shed light and very simple, easy to understand writing style for the layperson is to how inherently unstable banks are, and it's in some ways it's almost comical, and it's really a tragedy how we got to this point. Right? It's a couple bad um, Supreme Court decisions, a couple bad uh, UK court decisions that changed the law from being a bailment to being a creditor, and because of that, that's why we have fractional reserve banking today.
And there's not even a lot of cash at the regional banks. It's all digital. So if you go to the ATM or you try to go to the cash in the safe in a regional bank, I mean, they hardly have any cash there. It's all credits and keep stuff on a keyboard screen, but it's all reserved. So the average banker, like you said, the person who's working at one of these bank tellers, they don't even know how the system actually works. They just know that if their regional bank branch gets in trouble, they just make a phone call to a person above them or someone at the Federal Reserve Bank, and the funds get wired over like monopoly money.
Yeah, they really don't have. If anyone goes to a bank and tries to get a significant amount of cash, besides the scrutiny you'll endure, uh, they just don't have the funds. You actually have to call them like a week in advance, right? Because they don't have the money. I don't know what they have, but I'm guessing it's not more than a couple $1,000s. Um, but it's so bad that there was actually by my office, we had a bank down the street, and it was there forever. It's gone now. But they actually, I walked in one day, I forget what I had to do, but I wanted some cash. And they said, well, we don't have cash anymore. We're a cashless bank. They literally said this to me. I was like, that's like being a foodless restaurant. It doesn't make any sense what you're doing. But they thought, they looked at me like I was an alien, like this is the way
Wait,
we're going, right?
does that
Why would
mean
you do
that
that?
like all of their deposits are not even done by paper check anymore? It's all like wire transfers and debit cards and stuff?
I wasn't there long, so I didn't find out. But all I know is that I could not get cash out of that branch.
That's just ridiculous. I mean, that almost sounds like mainland China. I mean, like I have friends who live in mainland China, and they were trying to explain the current system there of cashless society. And basically, just to pay in cash at like a restaurant, if you're going to buy like a lunch or something like that, you have to pull out your smartphone and scan a QR code. And then the QR code has to get scanned by the restaurant, and then you can pay cash. So it defeats the whole purpose. But they want to, the government and the banking system want like records that you went to this restaurant and you paid cash, so they could see if you're paying your taxes and what your spending habits are.
Yeah, it is disturbing. It's refreshing that a number of at least three Republican candidates have come out and flatly said they would ban, uh, not just not support, but actually ban any kind of central bank digital currency, CBDCs. That was refreshing. I do think that is a great danger to freedom that they mentioned. Um, and I'm actually surprised they haven't done it yet. I thought they would have done it a couple of years ago, but there's a couple things they haven't done which I thought they would have done. Like for instance, after 9/11, I thought we would have had national ID cards. I'm kind of shocked we don't. Thank God we don't. But there's certain things that they could have done, which for whatever reason they didn't. And thankfully, this is one they haven't done as far as pulling the trigger on CBCs.
Well, central bank digital currencies right now can't handle transaction volume at, say, the level that like Visa and MasterCard can. So that's what's they're scaling that up. So they're doing like test pilot projects. The governments can't do the transaction volume at the scale that, say, a credit card company can, which means that they probably need the banks, the large banks and the credit card companies and PayPal and those ones and Cash App and the other ones that younger adults use. They need all those companies on board. So it needs to be like kind of a merger in state of corporate interest. They have to get those guys on board.
Yeah, which all goes to whether it's by design or by accident. But that goes back to the bank consolidation that I think is somewhat inevitable that we're going to see.
So I want to transition now to your asset management side. So in a inflation or deflation environment, I mean, we could have a roller coaster here because the market's kind of hanging on everything the Fed says, whether I think the probability for a rate cut in March went from almost 80%, it's down below 50% now. I mean, it could fall even further. That could be asset price volatility, maybe short-term deflation. How difficult of an environment is this for a money manager like yourself?
What is difficult? It's difficult because frankly, there's not a lot out there to like. I mean, if you go through every asset class, even the ones that seem reasonable right now, you have this horrible feeling that things are going to get a lot worse. So, for instance, I'm a huge fan of Bitcoin and cryptocurrencies in general. but I can see things getting a lot worse in the next couple months before they get, I think, a lot better. Um, and you could basically take that same game plan and apply it to almost every asset class out there. The only good thing is that, and we've been doing a lot of this, just rolling short-term treasuries. But the only good thing is that interest rates are high. So unlike before, if you don't see anything out there that you like to buy, at least you get paid to wait. So that's the kind of the only saving grace in this environment. But it is a very difficult environment because you think the shoe's going to drop, and it hasn't yet. And it seems like it's taking forever because it's kind of like I forget who said it, but the news they always report this is the most anticipated recession ever, and that's true because we've seen a lot of signals for a long time. So, very
Doesn't it
difficult market.
doesn't it take an average of about 22 months though for an inverted yield curve once it starts for a recession? I think that's about the average approximately.
That is true, and we're right there now, right? Where you'd expect it to happen very soon. And I think that is probably the best indicator that's out there. I mean, the Fed claims that they think it's the best indicator out there, but they don't apparently listen to it, and they've got a ton of papers on it. And since 1950, it's almost been infallible. We've had no false um, positives, only one false negative throughout that entire time. So it's a very, very reliable indicator. You're right, there's a lag effect. Um, so things could happen fairly soon.
Yeah, it's just a total mess. I mean, I'm looking at the Mag 7. The valuations on the Mag 7 are nuts. I mean, I see people buying Apple and they expect a valuation re-rating for another $1 trillion in market cap. But a lot of these Mag 7 companies, I mean, they have almost no growth and their valuations are already high and everyone's just expecting a multiple re-rating. And I think the valuations are around 50 times revenues, but a lot of these companies have no growth. And then I hear all the time on business television, money managers go on, say, I'm buying those because they're still going up and they're quote unquote safe. It's like, well, what is safe? They're not going to go bankrupt, but their valuations are nosebleed levels. Same thing for the S&P 500, which is at an all-time high, but I see a lot of problems with the global economy.
Yeah, and in those large tech stocks also just fail any kind of test of they don't pass the smell test, right? So for instance, if you have a market cap of let's say 1.5 trillion, and to double that, I mean you're going to be at a huge percentage of GDP. I mean, is that really reasonable to think that one company is that big of a chunk of GDP? Is that ever had? I haven't seen a study on this, but it'd be interesting. Like, what's the biggest company relative to GDP that the U.S. has ever had? Is it GM? 50 years ago, I'd be surprised if it really was all that significant relative to where we are today.
I think the Mag 7's larger than 40% of the global economy now. It's an enormous percentage. I had on another money manager, Kevin Duffy from Bearing Asset Management. He said that the global stock market index that the U.S. makes up 70%. I think it's the largest all in history.
And I do think that looking at it from that percentage or that perspective is a great way to do it instead of just looking at even normal valuation metrics, because a lot of those can be distorted, right? About if you're looking at anything prospectively, there's always some good optimism and good news you could bake in and try to make those valuation numbers work. But just looking at a test of reasonableness, it reminds me of what was that famous? It was the Imperial Palace, back in the '80s in Japan, was worth more from a land value perspective the entire state of California, right? So just looking at from things in that perspective, I think really helps people make good investment decisions.
Yeah, China had a real estate bubble similar to that a few years ago. The valuations were absolutely insane.
Yeah, and for the same reason, back to the Austrian theory of economics, right? They pumped up the money supply, and that's why you see probably the best examples of malinvestment anywhere are in China right now.
The Chinese economy is very centrally planned. Yes, I would agree with that. Unfortunately, I see a lot of mistakes all over the globe. It's all because of governments and central banks. I mean, Germany and their ESG. I think the ESG bubble. If you want to talk about malinvestment and central planning, the ESG bubble for European Union, the U.S. There's been just tons, hundreds of billions, if not trillions, of bad investment for wind, solar, biofuels, those types of companies.
It's true, but it's also in some ways perversely an opportunity, right? So you look at things that are not obviously ESG compliant, if you will, whether it's sin stocks like tobacco, uh, whether it's energy, a great example. that does present opportunities there. But I mean, it's the ultimate, contrarian play, going against kind of the ESG uh, motive.
Yeah, I totally agree. Look at uranium. Now it looks like there's a policy reversal for nuclear energy for a lot of different governments. We'll see if they actually allocate the capital. But I think there's been a lot of opportunities for the non-ESG energy plays. Also commodities. I think even though capital was cheap, in 2020 through 2022 before the Fed started hiking rates, a lot of that capital was not going into any commodities investments at all.
Yeah, commodities I find intriguing because they're cheap from a number of different angles. But on top of that, I mean, there are some risks, right? You're going to see pain if China really kind of implodes, the Chinese economy goes in. You're going to see a lot of pain in the commodity space. On the other hand, just like you see in energy right now in the United States, there's been almost a war preventing. There's been supply destruction, or I should say, at least supply growth destruction that augurs well long term for commodity producers. So, interesting space right now. I do like commodities. I just don't know if now is exactly the right time, but they offer a lot of potential.
Yeah, I agree. Risk reward. I know you're a contrarian value investor. I see a quote here right on your profile page on Winrock that investors follow the herd, subject themselves to more risk and less profit than those who act with conviction in their analysis. So I don't suspect that a lot of people on business television are going to agree with what you said, because a lot of people go on there are whatever's going up, they buy the trend.
That's true. By the way, I was trying to rack my brain as to what that quote from. I think that's my quote though.
Yeah, I said
that,
I pulled it right off of when. Yeah, I'm pulling it right off your profile there.
yeah.
When
No,
you're
I
off the
couldn't remember
website.
if I was quoting somebody, but that's actually what I wrote. So no, I totally agree with that. I think just from a philosophical perspective on investing, you know, doing acting as a contrarian um, is the best way to go about it. It's most profitable with the least risk. I think the biggest problem is that you really have to look for catalysts as far as what will change, at least the perception in the marketplace, to really realize some nice returns.
I think we're seeing that over the last like 18 months with uranium, although I don't think people should go out and buy uranium stocks, especially Cameco right now, but maybe if there's a pullback. But yeah, the uranium is like the best near-term example. Another one's food prices. I mean, the soft commodities have been on fire, but a lot of the producers of those and the fertilizer companies have not done well. There's a long-term problems here if food prices stay at these levels and the farmers are not planting new crops.
Yeah, I think you see that with a lot of producers of commodities. Like, so for instance, the gold miners, obviously gold's done really well. They should be making money hand over fist, and many are. But on the other hand, their costs rose quite a bit. So there was obviously a negative. But I think you see that across the board, and especially if you're looking at like a European company. So if you're looking at a European company, commodity producer that has big energy inputs or energy costs, that while it may look cheap, it may look like a great investment, there could be a great deal of risk just based on the volatility of energy prices over there.
So, last question here. Do you think that the policymakers, so the Federal Reserve Bank, the politicians, the bureaucrats, will they actually allow deflation for a long period of time?
Deflation, no. What we experienced after the Great Depression, we're never going to see again under our current Federal Reserve system. And there's a couple of reasons for that. One is that back then they actually had their hands tied, right? They couldn't increase the money supply for a couple of reasons the way they wanted to. Now the handcuffs are off and they can do whatever they want. They don't even have to buy treasury bills anymore or treasury bonds. They could buy literally, and they have, right? We saw that with corporate bonds, etc. A couple of years ago. They could basically buy anything they want. And if it's not legal for them to do so, they'll set up some shell company where they lend funds money. They lend funds to it, and that shell company goes ahead and buys it. That's what they did with corporates, right? So that's one reason. Another is that incorrectly, they are terrified of inflation. They're absolutely terrified of it. I'm sorry, deflation. And that's a fallacy. They should not be. Deflation actually is the natural state of things. Deflation actually helps people, but they incorrectly, in part due to Milton Friedman, blame deflation for creating the Great Depression. So they're terrified of it. That's why they have a 2% inflation target, even though there's zero academic research or common sense to support that, they arbitrarily pick 2% because it's not zero, right? It gives them a little bit of cushion. That's literally the basis of it. And finally, inflation naturally helps them, and naturally helps, as you mentioned, from the Cantillon effect, the producers of inflation are the ones that benefit first. Um, and they have no choice. They have to inflate because given where the fiscal situation is in the United States, and given the fact that the historic buyers of treasury bonds, like the Chinese, are walking away and not buying nearly as much. In fact, um, selling their bond holdings, the Fed is one of the last entities holding the bag, and they pretty much have to buy. They're going to be like Japan.
Except Japan was the only, I would say Japan was the only country doing that, and they exported their monetary inflation with the yen carry trade to hedge funds. So there was a lot of Japanese currency via the yen carry trade that helped inflate the stock market, Silicon Valley with SoftBank, other stuff. So yeah, people are like, oh, Japan had deflation. Well, they export, I would argue they exported a lot of their inflation through the yen carry trade, and it went into other asset markets. But I think you brought up a very interesting point, Chris. I would argue that the government spending, the DC spending, that's very inflationary. These budget deficits, the transfer payments, the bailouts, that's anti-deflation policy here.
It is, and the magnitude of where we're at right now is so great. I know I used this number before, but last year we had a deficit of 1.7 trillion. Think about that. That is the largest deficit we've had without a recession or without so-called national crisis, right? That's just normal times, right? Which actually the current administration is saying is actually good times. And you still had kind of a record deficit. So you're right. There's due to the fiscal situation, it's inherently inflationary.
And this is debt fueled spending too. So the US Treasury is not spending surplus. I mean, Keynes argued, so that the official, what the general theory, Keynes said that the government should build a surplus right in good times and spend the surplus countercyclically right in bad times. But none of that actual Keynesian policy has been implemented. It's just been deficit spending from Republicans and Democrats, or Republicans are what, supply siders. We've had some type of MMT, I would argue, since 2020. So there's been a mix of like deficit spending. Both political parties just want to spend.
That's true. And you're right about the Keynesian theory is that they have surpluses in good times. I mean, that's most people forget that, right? Partially because we haven't had that since Andrew Jackson, but that was the concept, right? You had these surpluses, and it was just as important as the deficits, right? It's yin and yang. You had to have both.
But I don't think we've had a surplus. So, I mean, technically, I think Bill Clinton was the last one that had a small budget surplus, but there was a lot of people arguing that they weren't counting a lot of stuff. But I mean, really, since I would argue the rules changed so much since 2008, the system collapsed. And when the Fed went to zero interest rate policy, balance sheet expansion, the QEs, all the hidden bailouts of foreign banks that we found out with what the run Paul audit of the Fed, the system more or less looks like a fiat currency and credit Ponzi scheme with the amount of currency creation and credit and debt growth.
Well, that's absolutely correct. And by the way, the Clinton years did not create a surplus. I know that's commonly trotted out there in the mainstream media, but the truth is, you can't have a surplus by definition if the debt increases year over year. So this is just right there. We did not have a surplus, let alone a balanced budget.
Just more accounting games. I mean, the average person doesn't understand this. The accounting here from the federal government, Washington, D.C., the Federal Reserve Bank, the Pentagon, the U.S. federal government agencies, they do not have to use generally accepted accounting principles. I know you're a certified public accountant. The average person does not know this, and all the games and shenanigans that the government gets away just with accounting.
Well, they do. And a lot of it's what they call, off balance sheets or off the books type accounting, whereas and you can see that with the debt levels, right? So we have a $34 trillion debt. But if you add in all the obligations of the US government, which are not counted in that debt. So for instance, if you add in anything from, pensions, what have you, that balloons dramatically. So there's a number of people that have done work on this. I think Kotlikov was the Boston area economist.
His estimate's at the highest end, though, right? So I mean, like I think Stanley Druckenmiller has around 80 trillion of liabilities, but Kotlikov, he was 150 or 200 trillion of unfunded liabilities.
Yeah, and cut, either of those in half or by a significant margin, and we're still, it's still a disastrous situation.
The math just is starting to not work because, like you said, the top line item, one of the top three, it might be the top one soon, is going to be interest payments on the debt. That's going to be way more than Pentagon defense and a lot of the other top line items that both political parties take for granted for spending.
That's true, and it's even, I think, worse in the sense of we're already at the point where the so-called mandatory spending, so spending that's already been authorized on a recurring basis, already exceeds tax revenue. So pretty much everything that's not mandatory, like defense, is basically borrowed. We're basically using a credit card to create the Army, Navy, etc.
That sounds like a good reason why these foreign governments, so China, Germany, Japan, don't want to be buying a lot more U.S. treasuries.
There's that, but perhaps even more immediate in their minds would be the financial repression that could instantly happen if you run afoul of U.S. government foreign policy. So, for instance, obviously we saw with Russia what happened there. The most draconian measures I've ever seen taken against another country, where literally corporate stocks, which had no Russian ownership, were delisted. Right? I mean, this is the most draconian you could go. And we could argue, people will argue whether or not that was justified, but the point is, I've never seen that before, and so I think that really spooked the Chinese, and that's really when they started not only just not being a buyer of U.S. Treasuries, but lightening the load that they have. Because if there was a war with China, I mean, the U.S. could just say, that trillion or so that we owe you, we're just not paying you.
It spooked the entire non G7. I mean, really, I think like 4 months after that, all of the non G7 have been large net buyers of gold tonnage. So if they're running trade surpluses, they have some foreign exchange reserves, they're not recycling a lot of that into US treasuries. They're buying gold tonnage. They're talking about investing in the BRICS. So that's really accelerated. I would call it DC tried to weaponize the dollar. And it's what the old Looney Tunes cartoon with Yosemite Sam or Wile E. Coyote, it just backfired on them and blew up in their face.
That's true. I mean, it definitely made people more cognizant and concerned about it. I have doubts whether or not there would be a legitimate gold-backed currency, because frankly, no government wants that, right? It's inherently contravenes anything they're attempting to accomplish. They don't want, just taking power out of their hands. So I'd be surprised if that happened. It'd be a great move, right? It'd be a great move for in a number of ways, but I'd be surprised if they actually got together and did that.
Well, I mean, the BRICS maybe could be non-gold backed. It could have maybe a basket of other currencies. It could have like kind of a similar to a special drawing right or something like that. But yeah, I agree 100% about a gold standard. I mean, I get argued with a lot of libertarians and people that say they know the Austrian School of Economics, but I mean, no government or central bank with all their budget deficits and spending, they don't want a gold standard because they don't want convertibility. So China doesn't want gold leaving the country. The Chinese government has accumulated, or their central bank or government agencies, they don't want gold leaving the country. Convertibility on a gold standard also gives them no flexibility to save their banks or real estate developers, large corporations, stimmy checks, ballots. A gold standard strips that. It forces them to adhere to strict standards. They can't do any of those things.
That's true, and they can't inflate. It is kind of, and it's perverse, right? Because if you were trying to have a strong economy, it's one of the first things you would do. You would attract so much capital, it'd be ridiculous. So perversely, it's exactly what they should do. In fact, they should be incentivized to do it. But there's other things going on which are preventing them from willingly doing that.
Well, I would say that most of the people running these governments and high at the bureaucracy, it's very similar to Atlas Shrugged. You have a lot of you have a lot of people with law degrees who are like gangsters and criminals in all these different governments, and they're not doing things in the best interest of the people. They're doing things for self-enrichment for themselves. I mean, with the Cantillon effect, right? They're stealing as much as they can before Rome burns down.
Well, you'll encounter problems before you even get to that level, right? So you don't even have to be um, have malicious intent. You can simply, like most people would, when you're not an owner, when you're just there for a short period of time serving out your term, your incentives are very differently aligned than the way they should be for the betterment of society or the economy. So you, we don't even have to. I mean, yes, I totally get that a lot of people are like that, but you don't even have to get to that level to already have distortions and problems.
Well, if we had term limits, I mean, and people and Congress was getting a lower salary, I think that's how it started in the United States. With the average person who came to Congress, they were only here to vote, right? And then they go back home because they had a farm or a business, right? That's how Congress initially started here in the United States. There wasn't permanent residents in DC setting up shop and talking with hedge fund managers or real estate developers or negotiating side deals or on the phone all the time, right? For fundraising. Now with the average Congress person and their base salary is around $178,000 a year, but they get all these other perks. And then they're doing insider stock trades and they're not going to prison. Some of the people are grossly outperforming the S&P 500. I mean, the average congressman now is outperforming any hedge fund manager.
Or congresspersons' husbands as well.
If they negotiate an unbidded contract through one of the government agencies and a family or friend is on the board of directors and they all got their discounted stock options for a couple pennies and then they're selling out before the shares crash, some of them can make thousands of percent return in a couple of years. And no one's going to prison.
Yeah, unique times we're in.
Whoa, what a mess. What a corrupt system. I think, honestly, Chris, a lot of it's because of fiat currency. The U.S. has a world reserve currency and then fiat currencies, fractional reserve banking, all these things together. It's just there's a ton of incentives here for waste, fraud, corruption, abuse of the system.
Right, and that's just even apart again from the basic economics of just inflating. Look at, as we described the Austrian business cycle theory, just inflating the money supply creates just so many different issues. Let alone everything else on top of that. So that alone is a problem. Everything else, in a way, is just aggravating things.
So I really enjoyed our discussion today. Let's plan on having you back in a couple of months for an update. Please tell my listeners more about Winrock.
Yeah, so we're a wealth management company and registered investment advisor. We have clients, throughout the country. I think we're in like 27 states right now. We have offices in two. Been around over a dozen years, or around a dozen years. We help individuals from a net worth perspective. We can go as low as probably 500,000, but most of our clients are probably in the 2 to type 20 range. And, we use Austrian economics to kind of frame our outlook on the financial markets. So we're a little bit more contrarian, I'd say a little bit more nimble. We're willing to, consider a lot more private investments than a traditional firm. And so I think we have a unique perspective and unique solutions for people who are like-minded.
Oh, does that mean like you guys are doing like private placements on profitable resource companies or oil companies or tech companies then?
We've done that, but we've done it, for some very high net worth individuals in certain specific circumstances. It more so means that we're willing to look at things which most wealth managers won't look at for kind of silly reasons. So I'll give you an example. We own through a couple different funds, we own farmland, and we like farmland for a couple different reasons. Not just like the Jim Rogers supply demand type stuff, but we like it as a long-term inflation hedge. It's performed very well, especially over the last couple of years. But most wealth managers won't touch that. They won't touch it because most of the farmland products are private. And effectively, you don't really have a good index that they can point to and say, hey, you beat the benchmark or you didn't beat the benchmark. So we take more of an absolute return type perspective as relates to investments. And so we're just more willing to embrace things where we think the risk return profile makes sense. Whereas a lot of wealth managers won't touch them because whether it's a sales culture, whether it's because they can't, in their minds, properly benchmark it, what have you, we're just a little more entrepreneurial and willing to look at things.
Yeah, I think there's a lot of opportunity in farmland. We were talking earlier. I think there's going to be potentially a food crisis going forward because the farmers, even though soft commodity prices, cattle prices, a lot of those soft commodity agricultural prices are high, the farmers are not planting new crops. So I think there's a lot of opportunity there. Plus, if you're selling like organic grass-fed beef steaks or organic fruits and vegetables, those things sell at a premium.
Yeah, there's a lot of different ways to play it. There's, I think, a lot of opportunity. And that's one example, but there's other things we've looked at or done over the years. which I think most wealth managers would not have done. So, for instance, we've been involved in cryptocurrencies for quite some time. I mean, I think we have an article we wrote about it back in 2014. So we have a lot of clients that have been in it. And that's just not something that anyone probably would have touched in the wealth management space, I'm guessing, until like this year.
Well, since you've been around that long, I mean, back then, if you worked at a Wall Street bank and you won a business television and you said anything back around 2013, 14, and even 2015 about Bitcoin, I mean, you were looking at potentially getting fired. So things have changed a lot on Wall Street now. Look at the promotion of the Bitcoin ETF. So the narrative has changed a lot for Bitcoin and crypto now.
It has. They figured out how to make money from it, right? So Jamie Dimon went from, I think he was the one, he literally said he would fire anyone that
Well,
was advocating it.
Well, Larry Fink too. Look at the 180. Larry Fink said, 12 months ago, 18 months ago, he said it was only for criminals and money launderers. And then he started buying in the last 6 to 8 months Bitcoin miners. And then because he is Mr. BlackRock, Mr. Big Shot, right? He can easily get a Bitcoin ETF approved compared to the Winklevoss.
Yeah, no, that's typical Wall Street.
Well, it sucks for the Winklevoss twins. I mean, they tried so hard for so many years, and now 11 Bitcoin ETFs got approved by the Securities and Exchange Commission very, very quickly from all the big shot Wall Street firms.
I'm sure it's coincidence.
Along with the information leak and how like a lot of the trades were set up, 7 to 10 days in advance that the Bitcoin ETF was going to get approved.
Yeah, but Bitcoin's interesting. I mean, I like I said before, I do think we could have some short-term pain, but with the halving coming up later this year, I think, and we've been involved in Bitcoin for a long time. I think it's cryptocurrencies in general are kind of a unique situation here.
Well, I would argue they're free markets. So if you're in an emerging market country like Argentina or Venezuela or another country where there's even more currency debasement than the US, so the inflation rate's even higher, Bitcoin's a good alternative there for you to get out of your domestic currency. So I think there's a lot of emerging market demand.
Well, we saw that with China years ago, right? We saw when they had currency controls, capital controls, that Bitcoin skyrocketed. And you could gauge it also based on regions. You'll see great pricing disparities in troubled regions versus more free economies. So we saw that whether it's anywhere from Uganda to Ukraine to China, you definitely see that.
Excellent. Well, thank you so much for your time, and I really enjoyed the discussion tonight.
All right. Well, thank you.